This is episode 9 of the Tax Smart Daily, a daily video series for real estate investors to learn about tax savings and stay out of trouble. I'm Brandon Hall, and before we get started, I want you to mash that subscribe button. I want to make sure that you don't miss any new videos that we're dropping. We're producing a lot of good content here, and I want to make sure that you're fully aware of all of it. I also invite you to join our Tax Smart Facebook group and the Tax Smart newsletters. The links to both of those are in the description of this video. Lastly, if you like anything in this video, if anything resonates with you, if you have any questions, please leave a comment with a timestamp. I love interacting with our community. It means the world to me that you spend a few minutes out of your day to type up a comment and interact. So thank you very much to those that have, and I invite everybody else to jump into the comments as well. Now, today's topic is about investing in ATMs. So there's ATM syndicates out there that will pool money to buy ATM machines, automated teller machines. So yes, we're talking about when you walk up to Bank of America and you see the big ATM machine, those are the ATM machines that we're talking about. You can buy ATM machines. I think they cost like anywhere between $1,000 to $2,000, and then you can earn passive income on the fees that the ATM machines generate over time. The cool thing about ATM machines, though, is that they are all considered personal property, meaning that you can 100% bonus depreciate the cost of ATMs, at least today in 2021. Those rules may change in with the upcoming administration, and they are expected to be phased out over the coming years. So if you're watching this later, check the bonus depreciation rules before you take this as gospel. But today you can 100% bonus depreciate, meaning you can immediately expense the acquisition cost of these ATM machines in the year that you place them into service, as long as they are new to you, not like used and you're just passing this machine around. We'll talk about that on a different day. But the point is that if I spend $2,000 on an ATM machine today and I place it into service and now it's earning fees, I can write the $2,000 off immediately and effectively not have to pay income or not have to pay tax on the income that I'm earning because I've created this big loss. Now here's the issue. We see clients get involved in ATM syndications. Nothing wrong with syndicating the acquisition of ATM machines. But what's wrong with it is sometimes the syndicators, the deal sponsors, will tell you that the losses that the ATM generates are non-passive for you. And that is not true. Because you are not materially participating in the entity, in the syndication. You're a limited partner. You put up some money and that's it. You're not involved in the day-to-day operations. You're not making management decisions. You're not voting. You're not materially participating in the operations. Any income or loss passed back to you is going to be subject to Section 469, the passive activity loss rules. So I just want to make sure that you understand that just because you've placed $100,000 into an ATM syndication does not mean that when you get a $60,000 loss passed back to you, that you can use that $60,000 loss to offset your W-2 income. It's not going to work like that because you are passively involved in the ATM syndicate. You're not materially participating, thus any loss or income passed back to you is going to be passive. Now, the ATM earnings that you will receive over time, those are that's passive income. So if you have previously accrued a large passive loss due to your ATM investing, then you can use that passive loss to offset the passive income coming back from the ATM machines over time, because most likely that passive loss will be suspended on your tax returns and carried forward over time. So you do have some cushion that will protect you from future earnings, but just want to make really clear that in the year that you make this investment, even though you get that great bonus depreciation, it's still passive, and you're still trying to figure out, just like every other real estate investor, how do I qualify as a real estate professional to move my passive losses over to the non-passive side, except for the fact that ATM machines, real estate professional status won't help you there. So you do actually have to materially participate in the ATM business in order to move it from that passive bucket and into the non-passive bucket. Thanks for watching today's episode of the Tax Smart Daily. Again, if you resonated with anything that I said, or if you have any questions, leave a comment. I really appreciate it. And we will see you on the next episode.